So for this week, we're going to be covering basically how to choose the golden contract, and in more wordly length for that is basically how to find the contract that truly fits your account size, that fits the setup on the chart, whether it's the smaller frames, the larger frames. The biggest reason why I think Jarvis and I agreed on doing this type of thing was the purpose of helping all around people and not just saying, this is the contract we like, or Hassan saying, this is the contract I like, or Kenny saying, this is the contract I like. Everyone has their own style. Everyone has their own repetition they use based off what they have used in the past, and it just works well for them. So I'm going to try and touch on multiple aspects of different techniques, I guess you can say, or at least different contract premiums that you can choose from based on the account size, whether it's the sizing that you want to use with the contract you choose based off price. Maybe it's the volume that comes with the contract, or it's the Greeks that may associate with it. Never liked going to class until now. I'm glad you feel that way. But yeah, the way I trade is very safe. You guys should know that by now. My risk is very small. So when I play specific contracts, I'm not just playing a contract because it's cheap or it's right at the money. I'm focused on a variety of aspects that come with the purpose behind why I choose it, whether it's the Greek association with it. Question: true or not majority of all traders get in at the money? I mean, it's hard to say all traders get in at the money. The biggest thing that I can say, traders will do what they feel best with when it comes to heavy sizing, or just how your emotions are as a person or as a trader. All your premium choices are based off what you can risk to lose, or they're just going for a home run play, playing out the money. They're playing safe at the money, but sizing heavier since the contracts are more expensive. I'm going to be touching on all that stuff while I break down each concept. I have 4 examples with Amazon, DraftKings, Netflix, and Tesla. I didn't want to use an expensive stock like Chipotle or I can't even think of any of those stocks off the top of my head, like ones that are in the thousands, basically. I didn't want to choose any up there only because they don't move and I'm not familiar with them. So I chose obviously DraftKings for the cheaper side. A lot of people don't understand and won't trade options on stocks that are cheap. So I wanted to throw in an example of one that I actually do trade. I do track it because the contracts seem cheap, but if the result is correct with your analysis, it can go bigger than what you expect based off the current price you're looking at per contract. It's hard to look at a contract that costs $4 or even say up to $10, 0.10 or 0.04. It's hard to look at that and say, oh, this can go up to 60 or 40 or even double, because the mind is so wired into the fact of you're focused on the financial standpoint, you're focused on the actual decimal point to what you're looking at for the contract. A lot of people don't realize the price is not the only thing that matters. And beginner traders, sorry, that was a tongue twister. Beginner traders don't focus on the Greeks. They don't focus on the possibility of the gap fill in the actual stock chart. They don't focus on the bigger picture. All they want to do is, okay, what contract is cheap? I want to get in cheap and sell for a high price. Or maybe experienced traders that just focus on the premiums, but they have more years in the market, more months, whatever it could be. I want to buy right at the money because it's safest. There's more to it than just at the money, in the money, out of the money for a big gain. There's a lot of technicals that come into this, a lot of statistics that come into this. So I'm going to try and break it down, not at a very slow pace, because I do want to try and get through this to answer questions at the end or throughout the entire thing. But we're going to start with Amazon just because that's one stock I feel everyone has at least looked at one time. So it's very familiar with how it moves, or at least the idea of like it can move $4 in a day, $5 in a day. Reasonably, it probably moves between $1 and $2 with chop or even just continuation. If it does have that, it can go $5, $6. So I'm going to give examples on each of these 4 with the week of contracts and also next week contracts. Along with the last class that we did on Thursday, I'm also going to throw in examples of the chart correlation when I like how you mirror the option contract chart with the actual stock chart, because it will give a bigger perspective on how to find and how to choose the correct contract with the price action of the stock. So when I'm looking at Amazon here, obviously I don't like trading in the smaller time frames, but just for examples with this class, I'm going to stay in the 1 minute, I'm going to stay in the 2 minute, just so it's easier to see the movements on the candles. You can only see the day of, because that's all that I want to talk about. I'm not going to be too heavy on swing trades with contract premiums. I'll touch on them, but it's not going to have any correlation with actual price action on the stock, since that's more so when you understand the short game with choosing the correct contracts, you can easily correlate it to a month out, a year out. It's way easier to start with the smaller time frames, because at that point, everything follows suit no matter how far out you go with expiration. The only difference is the contracts are going to be more expensive, they're going to move slower, and they're not going to have as much volume possibly. So there's not too many outside things that will affect adding time. So if you can understand the week of contracts with the correlation of how to find the golden contract, it's not going to be difficult to do it when you add a few weeks. I won't have to teach you that, because you will be able to just correlate the week of and then translate it over basically. So when we're looking at Amazon, I'm going to give obviously the market already happened today. The day's over with. We're going to look at the possibilities of what you would look for at certain points in the day off of the chart formation. So the one thing that I do want to start off with, I'm going to switch to the 10 minute just for a second. I'm going to break down entry points of how I would look at it if I took it. Amazon at open today pushed up to the previous day high, yesterday's day high of Wednesday, and it basically double topped. Even though it wicked above, it had that zone of resistance, of selling pressure. So we're going to use the example of the open push to find, okay, what's the best contract? What is the golden contract if I want to enter this Amazon for the week of? So when we break this down, for anyone that doesn't have Webull or know how it works, the option contract ladder is over here. I have the sections listed in a good order to follow. I have the bid first, the ask, the percent change, and then the most important stuff, the volume, the open interest, delta, gamma, and theta. I'm not going to be touching on IV or intrinsic value, since that's not something that I feel is necessary for finding the right contract. It is big on knowing if the possibility of the move happens, how much will the contract move, and I get that. But the visual and the basics is what we're going to cover for this specific class on the golden contract. So when we had this, obviously, historically yesterday, we know this is a double top. You don't have to go back. We just know at this point, mostly because I said it and I have this highlight here so we understand that. When we hit this peak, if you're not in the mindset of I have to chase this for calls, I already missed the entire $2 move on the upside. Say we're focused on puts. We're looking at puts, the price action of Amazon for the week of with contract wise. So the actual price of Amazon at this high was around $105 a share. I'm not going to add in the 0.25, the 0.5, whatever the decimal may be. I just want to focus on whole numbers to start off. And as we go through the rest of these 4 stocks, I'll get into the idea of going to the decimal, going to the nearest whole dollar. So starting off, Amazon basically tapped out at $105 a share. When looking at the week of, obviously the smartest choice that you can have is playing right at the money. The biggest thing that I tell people, psychological numbers are huge. If you don't know what a psychological number is, it's usually divisible by 5, 10, 25, 50. It's a whole number, obviously, but it's also like you look at it and it just stands out. When you're focused on those numbers with the contract premium ladder right now, 105, 102, 103, the reason I'm saying those and not going over 104, I'm just focused on the picture we see right now. When you look in the money, the first thing you see is 105. When you look out of the money, the first two you see is 103, 102. You're not focused on the 104. That's with the close price right now. I'm not focused on where it was at open. At open, it was at 105. So at the time of that, the 105 and the 104 would be right outside the money. So those would be the main 2 focal points when looking for the safest contract for the week of. If I click on the 105 the 105 put for this week, I am going to highlight this just so the correlation is there for you guys to see visually. So the bottom white highlight on the right is the 105 put for Amazon. And I did that highlight so it correlates the high of the day on the stock price action. When we look at this, the reason I have the 105 put pulled up, the current price of Amazon at the high was roughly $105 a share. The peak of it was 105.25. The biggest thing I tell people, what's the day of the week? When does the contract expire? You can't just go in blindly with, okay, Amazon is at 105. I'm just going to buy 105. Obviously, today is Thursday. If you play week of, logically, you know tomorrow the expiration hits. You have today when you enter, and then tomorrow. And then after that, if you're not in the money, the contract's at zero. That's it. If you're in these type of plays, you're going to end up scalping. You're going to play the day of. You may swing it if you're in the money, but you're focused on the overall picture. I'm getting in the 105 call. It expires tomorrow. I'm doing that because I'm right at the money. If we drop from the high at 105.25, if we drop 50 cents, that 105 is now in the money. There's not going to be as hard hitting on the contract when it consolidates or when it bounces back up, as long as it stays under $105 a share on Amazon. So for safest and no emotions, I would say, in my personal opinion, no emotions on trades is always playing at the money or in the money. So the psychological number at the high for Amazon for a put was 105. It's the logical pick. That's the safest. When you look at it from the time of, you look at the volume, obviously at the end of the day, the highest volume contract for the week of was the 104 put. Now I'm going to explain why that would have more volume than the 105 would, because like I just said earlier, you're looking at psychological, and I mentioned 105, 103, 102. I didn't say 104. In the moment of this contract hitting the high of the day, I'm looking at the 105 because from my expertise, from my historical trading that I always do with this strategy, if I want to size heavy and have low risk, I'm going to play right at the money. So I'm focused on the 105 contract for the put side. For the people that may not want to size as heavy, when we look at the low for this contract, it's around $80 at the low. In the zone of Amazon at the high, it was roughly it was like $85 to $90. That's a reasonable contract for the week of, knowing that it expires tomorrow. A lot of people are going to be looking at the fact of, well, I want to catch the move. I want to size less and hopefully get a bigger return for putting less money in. They're going to be focused on the 104 because that's $1 out of the money. The golden contract for safe risk is going to be the 105 because the price action was roughly 105. You're right at the money at that point. The 104 is like that extra room. If this pulls back the way it should based off yesterday's high, we're in a double top formation. You're looking at patterns now. You're looking at trends. You're looking at the correlation of, why am I entering this contract? And if I enter correctly, execution wise, how will the contract react and respect the levels based off the chart? So with Amazon having this double top, it's logical we're going to have a pullback at least back to 104.30, 104.40. So people that play scalps, but they want to put less money in, the 104 put, that's one of those contracts you can size less and the percent gains are going to be more, but it's also a higher risk because if you don't drop down, that contract's going to eat itself alive. You're not getting closer to in the money for the 104 put. Say Amazon just consolidates at the high at the 105, that premium is going to lose value so quick compared to the 105, which is going to be the safest entry. The golden contract, my definition for that, you always want to look at volume at the time as well. I can't go back to open with seeing what the volume was on these at the day, but at the end of the day, you can see which had the most volatility, which had the most eyes on it, and that was the 104 with the total volume. It had 36.9 thousand contracts bought and sold today. So going off that, it shows you right away people were eyeing the 104. And when you look at the overall like movement of Amazon today, it was roughly between $104 the whole day price action wise. The low was 103.20, the high was 105.20. So 104 was practically in the middle. That was basically the reasonable contract after the high happened. Because if you missed the initial entry of the 105 put at the high of the day, a lot of people, they don't feel comfortable buying a contract in the money. They'd rather focus on the one just outside of it. And guess what that would be? That's the 104 put. So obviously with close, the 104 is in the money. That's why I never mentioned it in the beginning, because a lot of people, when they look at stuff after the day's over, they're not focused on where the stock was or what it was doing during the day. They're focused on, okay, it's at close. This is what the option chain looks like now. I want to look at this for tomorrow. People aren't realizing the 105 That was the catch at the open. Obviously, if you played the 104, the 103, with the dip that happened, the returns may have been better, but the safest entry point for the contract, my golden contract for this play, if you would have caught the top, was the 105 put, because once you're in the money, it respects the stock. The pushback right here, obviously, on Amazon, we push back to about 104.60 area, 104.70. On the contract for the 105 put, you still would have been green on the trade. That heavy pullback did not take you down to red on the trade. If we switch over to the 104 put, now we're focused on the idea of theta decay, or the idea of how delta can affect when it moves against you. Delta is always going to be a higher percent loss or win when you're farther out of the money. It's going to take over the contract value based off the movements per dollar share of the stock price. So when we're looking at the 104 put, this pullback on Amazon on the stock chart, it basically brought the 104 put back to your break-even entry. That's the risk that comes with playing out of the money, even if it's only one slot. If I switch over to now, what did I write down? So another big thing people will do, I'm going to pull up, that's too far out. Let's pull up the 102 put. So the 102 put, obviously very cheap. This is one thing, this is one of those like a Hail Mary pass. For you to get a good return, I would say, obviously, the downtrend that happened off of the highs for Amazon, the 102 put, even though at the low right here for the Amazon stock, it was practically $1.60 out of the money still. That contract from the low to the high right there ran just over 100%. So going off the movement that just happened, it made a good return. The only issue with that is if this drop wouldn't have happened and it would just consolidate, playing out of the money, whether it's one slot, two slot, three slots, you're risking more than you imagine or even know about. You're not focused on the bigger picture of it. If this consolidates, or if this doesn't move, or if it goes against me. A lot of people don't realize if this breakout would have happened and you entered the 102 put for this week, say the breakout kept going, the 102 put would have got destroyed. And by the time it came back down, let's just say to this low point around 104.60, if it broke out at open and then came back down finally, the contract would be nowhere near your entry point. It'd probably be still cheaper. You'd still be red, even though on the chart for Amazon, it's lower than where you bought in. A lot of people, especially new traders, small account traders, they're not focused on the logic. They're focused on the hope. They're focused on the money they can make by putting in, ooh, $10, I can turn that into 50. Oh, if this goes in the money, I can make $100 on it. No one is focused on the technicals, new trading wise. No one's focused on, okay, what's the logical reasoning behind why I'm entering this? What's the logical result of what could happen based off the movement of this chart? There's a lot of stuff that I think a lot of people don't think about until they actually do it and find out the hard way. And by then it's like, I don't want to do this anymore. Or they blew their account and by then they don't even know how to manage a proper contract. They don't know how to enter the right contract. They don't want to enter the right contract because now they're focused on what I lost. I got to get back. I need to buy cheaper contracts for the bigger return. Playing the safest contract will not give you the biggest return. That's just facts. People will say it does. It's not going to happen. If the stock drops the way it should, or not the way it should, but the way you want it to for a huge return, playing right at the money for your entry, once you're in the money, you're not going to gain much percent after that. You're just playing it safe at that point. You can hold the contract and any pullbacks against you, it's not going to hurt you as bad as when you enter the contract five slots out the money. And then when the pullback happens, say you're only 2 slots out the money. That's where scalping comes in. If you're playing contracts a few slots out of the money, you can't really swing unless you can afford to do it after trimming, after locking in your gains. So many people will just hold the whole position because they want that move, and there's nothing wrong with that. The issue I have with it is I'm always focused on the long term. I want no emotions involved. Having pullbacks, even though they're less than the drop that happened, it hurts so bad for some people to see your contract lose value so quick, even though the stock price and the stock chart is holding trends, or it's still cheaper on the stock where you bought in for the contract. Playing at the money, the risk is lowered, the returns are lowered, but you have no emotions. The emotions are lowered. Everything else, it's all about perspective at that point. And I don't want to, I know CJ just said, put me on blast. You would be surprised. Every new trader has done this. I promise you, every trader at one point has tried to catch a $10 to $50 play just to make it go somewhere big, and it never happened. All this info I personally wasn't aware of. Breezy creating a new wave of traders. I'm doing my best, man. I think the biggest thing that I really hope with this specific class today, it's the idea of you're not just entering a contract to make money. You're literally entering a contract to lower your risk and make your trading stable. Like there's more to it than just, oh, I hit 500%. Well, what was the risk that you had going into that trade? What was your entry point? If you execute correctly on right at the money plays, you'd be surprised how stress-free it is once the contract goes in your favor and you're in the money. There's a lot that can happen for you. So I'm going to go to the next week now for Amazon just to show you when you add time, it's harder to play at the money if you don't have a large account. So we're focused on the exact same premium as the week of. The 105 put is what I'm showing you right now. I'm going to highlight the open just like before so you can see that. So the price for this contract, obviously the week before, it was around 80 bucks. Or was I think it was 60, my bad. Let me check real quick. It was $95. The 105 put was $95. My bad, $80. The 105 put for the week of was $80 at the low. If we go to next week now, you're adding time. That means contracts are more expensive. Outside of adding time, you have more time. It's not just you're adding time, you have more time, which means lower risk, less movements percent-wise. This contract, in correlation with the week of, 1 week out for the 105 put is $376 at the low for the contract. This is when it comes into the idea of if I add time, I have to play a few slots out the money, especially when people focus on, oh, well, I want to make a huge return gain. How are you going to make a huge return gain? You're focused on right at the money. And I get that. That's why a lot of people that play at the money, add in a week, 2 weeks, or a month, they size heavier. They can put in 10 contracts in this. They're putting in $3,700, but look how slow it moves. The high of the day are only ran just under $100 a contract. If we go back to the week of for Amazon with the 105 put, the low to the high basically ran almost just under 300%. So the idea of that is adding time and playing the same contract premium and move slower, but that's not how you should look at it. It doesn't just move slower. Your risk is lowered. Your emotions are lowered. You can sit here and watch the stock move against you, and you're not going to freak out over the fact of, oh, I'm only down 5%. If you play the week of and it goes against you, you could be down 20%, 30%. Think about sizing 1,000 on the week of and 1,000 on the next week. 20% down on both, it's not going to be the same movement. That's the biggest thing. The 20% on the week of may only be 5% for the following week. So you're still able to size the same. You just have to comprehend the fact that the golden contract, when you add time, is going to make a lower percent return. There's nothing wrong with that. So going off of low percent returns, let's take this out farther for the contract premiums. So for the week out, we're going to switch over to the 100 call. And remember the 102 call, I mean, the 100 put for this next week. The one I was showing before, the 102 put for the week of, it was cheap and moved good, but the pullbacks killed all the gains. It killed your green, your 50% up, your 100% up. When you play a week out, you're playing the $100 put. The biggest thing I tell people, it's a higher risk. Compared to the week of, the risk is not anywhere near the same because you have a whole week to figure this out. You have a whole week to let it marinate, to let it do its thing. Looking at the price for this, the week out 100 put is the biggest psychological number on this option chain for Amazon. Going off the volume, you can see the highest volume is the 95 put. Now, if you ask me, well, why is the 95 put higher than 100 put? A lot of traders are expecting a possible downside trend on Amazon at that point. That's my thought process. You, whoever is snoring, I can't even hear nothing, but I just did. So you're focused on the 95 put because it has more volume. If you're following contracts off of volume, you're going to be in for a huge maybe emotional ride, I would say. There's a lot of things you can't consider and a lot of things you can consider. And one of the biggest things is when looking at the 95 put, now that I extended it, you see volume higher, even farther out the money. The 95 put and the 100 put, going off price, we're looking at the 100 put for next week. It's right at $177 at the cheapest price possible. For some people, that's a lot of money. And it's not even the fact of I don't want to play it. It's just I don't want to put in $177 if the move is only going to give me $30 back. So the reason people then move farther out the money, whether it's the 95 put, the 93 put, the 91 put, the 89 put, people are paying less, hoping for that big move to make that percent return. There's nothing wrong with that. You just have to know your risk. For my personal opinion on this, my golden contract that I would look at, someone's typing. Coco said, how do you fall asleep at the desk? I didn't even know someone was snoring. That's my bad. So when I look at a golden contract for weeks out, months out, I'm not focused on the volume. The volume is important. It has to have volume. So like if I'm looking at Amazon, I would not buy the 101 put for next week because 755 contracts were bought today. There's only 2,100 of open interest, which means people that bought it on Tuesday are holding this into Wednesday. There was 2,156 contracts that were bought Tuesday and held overnight. That's what the open interest means. So when I'm focused on that, I'm looking at volume to see, okay, out of what choices can I choose from? You need volume to play a contract. It doesn't matter if you're buying 1, 5, 10, 100. If you have volume, it's volatile. It's going to move. People are going to buy at the ask. They're going to buy at the bid. They're going to move the price action, even if the actual stock is not moving. It's also going to make the spread on the bid and the ask way tighter with the more volume you have because it's more active. People are trading it very often. There's more limits set, more stop losses. If you're looking at a contract, look at the volume first and then pick out for your personal like account sizing or just your emotional stability, what's the best option for you? If I pull up the 95 put for next week, actually, let's go with the 93 put. It has the most volume, 3,700 volume bought today. So if we go off the 93 put, the low on the day for that was $45. That's cheap. So with me looking at that, okay, 45, that's not too bad. Now, what are the chances of the 93 put not going in the money, but just working its way towards the in the money section? Like, is Amazon going to drop? Because if it doesn't drop, this contract's going to get eaten alive. If we're looking at the delta is 11. So every dollar move on this contract, you're making or losing $11. If we look at the theta, the overnight for holding this throughout the day, you're losing $11. So if Amazon moves $1 in one day and that's it, the actual Amazon stock moves $1. The contract's not going to gain or lose any value. The theta and the delta cancel out. Your contract's at the same price. So it's all about the scalping at that point. Are you going to buy in and get out for a quick gain? Are you going to swing it overnight? Are you going to swing it into next week? You have to correlate all of this stuff to know which contract is really meant for you. If we go off the open interest, which means people bought it Tuesday, swung it into Wednesday, or no, bought it Wednesday, swung it into today, Thursday, the 95 put has just under 12,000 open interest. 12,000 contracts were bought on Wednesday and held overnight into Thursday. So if we open up the 95 put, low on the day was 68. That's basically the same price as the 105 put from the week of. Like, are you starting to see the correlation now? The 105 put for the week of was $80. The 95 put for next week was $68, both at the same time frame wise, but they're just different prices, roughly, barely. The difference is the return rate or the possible risk that's associated. Playing the 105 week of, if it rejects and drops that, if it pushes upside and breaks out, your put position is going to lose value quicker than the week out 95 put. You have less time on the week of. Any moves against you, your premium is going to get destroyed. Everything's going to slowly go down and not going to work out. So when I tell people playing a week out, 2 weeks out, a month out, you have to figure out. CJ said theta and delta cancel out. How does it work when one is more than the other? Maybe a dumb question, but I'm just trying to understand more. So Let me go back to the week of. So the more time you add, the theta is going to be less. That's usually how it works. Because the more time you have, it gives it more days in between. So every day the theta is going to slowly add up as the days get closer. So when you're playing the week of, say you're looking at the 103 put for the week of. At close today, the delta is 31, the theta is 39. What this basically means is when you buy and hold throughout the entire day, the theta is going to take off. Obviously, not right now because this does not correlate to market open. This is going to be for tomorrow, but it could change before open based off pre-market levels, pre-market prices. So I'm just doing this basically like off the top of my head. This is not accurate based off the movements. This is just what we see right now. So don't think this is going to happen. This is just for an example. Going off what we see exactly right now with the 103 put for this week, the theta is 39, the delta is 31. So tomorrow, since we closed Amazon, it closed at 103.81. We have to get in the money, obviously, tomorrow for the 103 contract to be worth anything by close. If it doesn't go in the money tomorrow, the theta will overtake the price and it's going to close at zero. That's basically what that means. It's always good to have delta and theta in mind, but you have to understand as well, the more expensive contracts you play, the delta may not be as much as the theta, because if a stock moves 5-10 points in one day, it's going to have a huge move on the contract, and the theta has to be a lot more. Because if a stock moves 10 points and the delta is only 10, that's actually 100. So the theta is going to be around 30 to 40. So it's going to be almost 3 to 4 times the actual delta price. So that's why everything is different. You can't just use one stock and then use that for every other one based off of the Greeks. Because I gave pretty in-depth information over the Amazon just so that when I go to the DraftKings, Netflix, and Tesla, I don't have to explain it as much. I'll more so just briefly cover the surface since I just broke down everything with how I would find the actual contract based off price action, chart setup, and just the overall perspective of like what your account's at, your personality as a trader, your emotions going into a trade. Everything comes full circle when you try and find a contract. I was saying in the beginning, it's not just saying, oh, this is a $20 contract. What if it goes to $200 a piece? The risk is obviously $20 a contract, but how quick of a move do you need? How fast does the chart have to break down or break upside for you to make money on that play if you hold it a few hours during the day? So I'm going to switch to Tesla first, just because this is a stock everyone has probably been watching today. We're going to start with the week of, and the examples that I have, we're looking at puts, obviously, because it's hard to use calls when the value goes down in those. So I'm trying to do correlation with actual market moves today to give your mind like an easy picture to make out, basically. So at the start of the day, let me zoom out so this is all there. So we're looking at Tesla at open. The first thing I always do when I find a contract, this isn't abnormal. I feel like a lot of traders do this. You take the price action of the stock and use that first to figure out what contract sounds reasonable. When playing the safest contract for Tesla, at open, we pushed up to basically the high of 169 a share, 169.70 to be exact. Right away, my thought is, do I want to buy a 160 put? A $9 drop on Tesla when it's already down heavy after hours in pre-market, could it drop another $9? Obviously, we saw it do that. So I'm speaking off what we see it open. I don't care about what already happened. I'm speaking on it's market open. It's 10 a.m. in the morning Eastern. This is my thought process. That's how I'm talking when I go through this. So Tesla already gapped down after hours in pre-market. A $9 drop, that's a very, very rare thing to happen. Even though it did, it's rare in the moment. So right away, I'm thinking, I don't want to get a 160 put. I'm going to be focused on something different. I'm going to look at the 165. I'm looking at psychological, 160, 165, 170, 155, 150. Psychological numbers are the whole numbers. That's the thing you want to focus on. After looking at that, you want to peep the volume. Obviously, the volume right now is based on the close and the entire day. At open, you want to see what contract is having the most volatility, what's having the most action going on. Like, where is everyone buying? What is everyone watching? At the time of open, we're ranging between 169 a share and 166. When looking at this pattern, symmetrical triangle, the wedge, whatever you want to call it, it's squeezing, however you want to determine it. If we break the low here, I'm looking at what's going to happen with the stock. That's how I determine my contract. What is the perfect contract if we break the support or if we push upside? So obviously, we know puts was the move today, so we're only talking about puts for the examples to save time with the call side. If I'm watching for puts, if we break down basically at this double bottom, at the rising support, whatever you want to call it, the breakdown is going to be around 166.50. At that point, low on the day in pre-market was 164. So my thought process is, okay, if I can catch this for a reasonable price, the 165 put can go in the money if we break downside. The golden contract for the week of contract with Tesla is going to be 165 put. Based off the reasoning why I say that, once you're in the money, your contract is not going to lose value as fast as a 160 put on a slight pullback like we had right here. Any pullback when you're out of the money is going to affect you more than you realize until it happens. That's when the idea of being up 100% goes to 30%, even though you're well below where you got in based off the stock chart. When getting the 160 put or the 165 put, all you need is basically a $1.50 drop from the open low, basically. Obviously, the low was 165, almost dead on. So if we get another touch at low on the day, your contract's in the money. The 165 put is going to be in the money. So when I pull up this chart now, the low on the day for this contract, if you caught the wick, very hard to do, it's not possible, but the low was $111 per contract, roughly going in the area where you may have gotten filled if you follow the chart setup. And I'm going to give a brief idea of patience, why you sit and wait. You don't have to chase a play. Look at the color coordination with these highlights. We have the orange there, and we have the yellow right here. The price kept getting cheaper as this flag, as this symmetrical triangle, squeezing, whatever you want to call it. As this was forming, the prices kept going down. There's no rush to get into this play. There's no point in trying to catch the move before it happens. You're watching the setup form. Once you see that we have lower highs and higher lows, you can try and predict, okay, if it goes upside, I want to enter on the bottom. If it goes downside, I want to enter on the top. If you can enter this contract around 130 for the 165 put, once it breaks the downside, your entry never got touched again. Like this could be raise your stop loss as it goes. You're guaranteed to make at least 100% on this trade. The reason the 165 for me is the perfect golden contract, you're in the money if low on the day breaks. Like that's it right there. Once you're in the money, contracts hold value. That is the idea of what you want to get in a contract. Playing out, say 5-6 slots, whatever it may be. If I switch over to the 160 put, and obviously it's the end of the day, we can see the overall volume now. The 160 put on Tesla had the most volume on the day for the week of. If we go to the chart though, the pullbacks were not as small as the 165 because we're still out of the money at this point in the day for Tesla. We're still 4 points out of the money. We're slowly inching our way there, so value is being held, but it's not as secure as the closer shot in the money. People for smaller accounts, they're going to look for the bigger move. I want to get the 160 put. I want to get the 155 put. That's fine to do, but you have to realize if that move doesn't happen like what happened today, your contract is going to go up 50%. It's going to consolidate. Then it will be back to 20% gain, 10% gain. It may go red. Can that affect your emotion? Can you handle it going red? If you're an emotional trader, if you can't hold through red, if you can't hold a contract that was up 50%, then up 10%, and you're thinking, I have to get out because what if it goes red? You may want to focus on at the money contracts, or at least something that's more reasonable to happen from a logical standpoint. When I first started trading options, I wanted the percent gains. I didn't care about or even know about Greeks, the contracts, the pricing, the correlation with the price action on the stock. All I wanted was to hit big. When I finally got my mindset where it needed to be, I was able to enter contracts based off logic, based off zones that can fill the gaps, based off the Greeks that give like an opportunity for me to make money while being emotionless or not having any risk associated. The 160 put obviously made money. We had a massive downside on Tesla. The only issue with this is if you held to the end of the day or anything, if you held through the entire day, these pullbacks are going to destroy your mental if you don't have a stop loss, or if you're just, I'm going to hold until tomorrow no matter what. At one point, this contract went to 137. The pullback ran it all the way back down to $70 a contract. Can you hold through basically a $60 drop, even though based off the chart, your entry was basically $4 higher than where the pullback was, but your contract is now only up roughly 100% compared to being up 300% just a few minutes ago or just an hour ago? Playing out the money, it's fine, but that's not the safest. That's not my definition of a golden contract. If you have the account to do that, if you can size for $100 and it goes to zero, you don't care. You can play the golden contract of what you choose or what you think is best. The biggest thing I show people is then say you go a week out, just like with Amazon. I'm going to speed through this one a little bit quicker. When you're playing a week out on Tesla, the prices are going to be way more, obviously. Not as much as Amazon. I mean, not as cheap as Amazon, but more, because Tesla's a bigger stock. There's more volume coming in and out. When you play out the week out 165 put, it holds value way more. If you look at the actual contract premium chart, you can see the correlation compared to the actual week of 165 put. This price gets cheaper as the pattern forms. When we play a week out, imagine how you have no emotion because it's holding value. This chart set up on Tesla price action is holding the contract almost the exact same way. So if you enter early on the yellow for a put on this one, you're not going to get freaked out when it drops. Because if you enter on the bottom, you're still green on the trade. If you're entering the 165 put for the week of, the less time you have, higher risk there is. Higher risk, higher reward. If you enter on the yellow for the week of 165 put, that pullback before the actual drop, you're down. You're red almost 20, 30%. Even though the setup and the pattern is holding, your contract is down in value. So when I'm looking at golden contracts for weeks out or a week out, a month out, what do I look for? Is it the price action of the contract? Is it the Greeks? Is it the volume? Is it just how I feel like, can this happen? The 165 is fine for the week out, only because if you can afford a $300 to $400 contract, that's your type of play. If your account can't handle that, you either one, you should not trade Tesla weeks out, or two, you just trade a cheaper stock or cheaper contracts on a stock and add time to those. That's where the idea of finding your safe place, I would say, the stock that you feel comfortable with. I have 4 examples here that show you cheap, very, very cheap, and then more expensive with Tesla, basically. So playing a week out, the 165 is going to be more expensive, but it holds value based off the actual price action for Tesla. The golden contract, going off price and just everything, it's going to be the 160 put for Tesla. Since it's a week out, you have a whole week for this to work its way into how it needs to play. And it's not that far of a move. A $9 move for Tesla in a week, that's not difficult. But a $9 move by tomorrow, obviously it happened. I keep saying that because people are like, well, it happened though. It basically touched 160 today. I get that. But imagine if it didn't. People only focus on either the hope of, oh, it can happen, or the fact of what did happen. So why are you even saying that? You have to think logical. The drop on Tesla today, I'm pretty sure not many people were expecting it to keep dropping after yesterday's after hours and today pre-market. So when playing a week out, you can afford to play the 160 put, maybe even the 155, but you have to realize the risk that is associated. If you want the lowest risk with the best possible, like non-emotional standpoint, you'd want to play the 165 put on Tesla for next week. But can your account handle a $300 to $400 contract? That's the biggest thing you have to consider. When looking at the 160 put for Tesla, it still basically held itself with the mirror to the actual stock price action. So there was no heavy emotions put in. Everything was pretty well. It wasn't like extremely serious. It wasn't too much for someone to handle, I feel like. But if you move this out, which a lot of people I know, the week of, they're playing 150 put, 145 put. Say you play a week out, 150 put. The emotions may come into this because you're paying way, way less. And if it doesn't move the way that it should or that you hope it does, one little consolidation, one little fake pump after you buy a put, your contract's going to lose value so quick compared to getting something like the 160 put or the 165 put for the week out. Closer you play to in the money, lower risk you have, the percents for the reward will also not be as big. So the risk is lowered, the reward is lowered. The best thing though, your emotions are lowered. Anything associated with the downside is not going to be as heavy when you play at the money. Obviously, if it goes against you heavy, if Tesla just flies up to 175, any premium right at the money or out of the money is destroyed. It doesn't matter what it is. So you're playing low risk entries to correlate that over to the contract chart or the contract pricing. Greek wise, the volume that's associated, is it going to give you an indication on what's going to move the best because other people are buying it? You have to take all this into consideration and figure out what do you need to see happen for you to enter a specific contract. The golden contract is not just what I'm telling you. I'm telling you the basics and the overview fundamentals. It needs volume. It has to be, for my preference, at the money or close to at the money. If you play a few slots out and you're wrong, you're going to lose money even though the stock is holding value. If Tesla would have held this 167 to 169 all day, playing a week out, your contract's not going to lose value if you're in the 165 or the 170. You may be in the money if you play the 170, but you're not going to lose as much because you're playing so close to price action. If you're playing a 160 put for next week, when it's at 167, 168, this contract will slowly diminish even though it's holding on price action. It won't be as bad as the week of, because being the week of, you have way less time. And I guarantee you, if Tesla would have sat here and not moved all day, the 160 put would have closed at probably $10 to $5 a piece. I mean, just in the first hour and a half of open, it went from basically 60 down to 30 off of not even a dollar move on price action. So imagine another 6 hours of not even moving. That's why I'm always focused on at the money when I have less time. If I add time to it, I can maneuver my way through it. I can make adjustments if they're needed. So I'm going to switch over to DraftKings now because it's a cheap stock. It's something a lot of people, I honestly know, it's not, I don't think, I know people don't watch stocks like this because they don't want to pay a little amount just to make a little amount. But here's the biggest thing about playing some stocks that are like this. If we're looking at the week of for DraftKings, we're looking at the lower risk, lower reward, but long-term is probably pays out more long-term. Yeah, so CJ, you said lower risk, lower reward, but long-term, it probably pays out more long-term. So yeah, basically when you're playing with low risk, low reward, in the moment, you're not making a lot of money, but it's the idea of you're lowering your risk to compound your way up. No, you're good. Yeah, long-term twice, you're good. It's the fact that you're growing. You're trying to compound your account. You're trying to compound your knowledge of what's best for you. You're not just working with 5 slots out the money. Then the next day, oh, I'm going to play at the money now. You're not staying consistent with what you have to figure out about yourself. So when you have lower risk and lower reward, it may not feel like you're benefiting yourself right now, making, say, the week of, if you played 2 slots out, you could have made 100%, but the next week playing at the money, you only made 50%. It's not about your returns. It's the fact that your risk was lowered and you still came out green. A year from now doing that, you may sell at 20% loss, but if you played the week of, you may have to sell at 60% loss. So everything has a result. There's always something to learn from a play or just a bigger picture long-term. Longevity is something I'm always preaching about. Where do you want to be in 4 years with this, 5 years with this? Not just, I want to see myself next week with $10,000. That would be nice, but how do you know how to keep it if you just got it out of nowhere and you've never done that before? So there's a lot you got to take into consideration. Do you want to play low risk for low reward for a better future? Or do you want to have high risk for a higher reward for a quick gain that you may lose in a few weeks after? That's something to really think about. So going off DraftKings, I'm looking at the white highlight from the day before. And when I'm looking at this, obviously we're switching the calls now since we're going upside. The highlight area of DraftKings on this day, which was Wednesday, was around $20.50. So at the time of that contract, we're going to look at the money, the 20.5. Don't look at the volume. Don't look at the open interest. I am doing this review based off yesterday's action, not today. So everything that you see today, like, oh, the volume for the 20.5 is only 272 contracts. That was today. The example I'm giving is from yesterday when people were actually playing this at the money. They were playing the 21 call at the money yesterday. So just like take the example, don't focus on the fact of what today's numbers are saying. So when we look at the 20.5 call, going off the low, it was $37. The high of the day was basically $100 a contract. So this cheap contract, I don't want to play it. It ran just over, well, just under 300%. No, 200% in the day. 37 times 2, basically just under 200%. So when we're focused on that, it's the idea of you're playing right at the money. The 20.5, you're literally at the money. If when DraftKings bounces here, your contract's in the money, you're good. Time is not going to affect you as heavy, especially when it keeps pushing upside. So when I tell people about these kind of stocks, their first instinct is, so we're going to go back to the 21 call. I think that was what I was looking at. Let's go back out one more. Let's go 21.5 call. So the 21.5 call yesterday would have been roughly $9 a contract. When you tell someone that, it's like, oh my gosh, $9. This could turn into like 100. Okay, yes, I get that. The biggest thing you have to realize is playing the 21.5 call when the price action is around 20.5, you need a dollar move on a $21 stock. A $1 move on a $20 stock is a 5% gain. That is a massive move, even though I know how DraftKings moves. I know that's possible. But for a new trader, they're not thinking about that. All they're focused on is, man, if this moves up $1 and I buy this for $9, I can make so-and-so amount back. They're not focused on the fact that this doesn't move like that all the time. If we switch to the 30-minute on DraftKings, before this major run-up, look how much chop there was on this. Like, yes, it was moving up and down $1, like back and forth, but imagine catching the mid-move and then not making any money off it. You have to be able to catch the zone to get that big move out of it. So when we're looking at DraftKings, stocks that are cheap like this, you have to play right at the money. That's just how this is all bias, obviously. This is how I feel. Playing at the money for cheap stocks is going to be the safest move because a short move in the direction you need to be beneficial, you're in the money possibly. You're more safe off time decay. You're not going to be affected if the contract doesn't move at that point. You'll still lose value, but not as much as being, say, 50 cents or $1 out of the money for a contract. If we're looking at this cheap stock for a week out, this is when you can give it some room to move. So I'm going to look at a 22 call for for DraftKings yesterday. So going off the 22 call, this is for a week out expiration. This is basically $1.50 move in a week and 2 days, which in my opinion, that's a 5% move for a stock that's $20. That's not hard to do in a week. That's literally almost 7 trading days. So when focused on that, you're paying $20 for an entry. Since you're playing a week out, you guys should start to understand this now. Adding more time means you're going to make less of a percent return compared to the week of. Adding time, lower risk, lower reward. That's just how it is. Contracts will be more expensive, but the risk is lowered, reward is lowered. So when you're playing DraftKings for a week out, you can play at the money. That's fine. Playing the 20.5 call, that's fine. Just realize it's going to be more expensive. It's going to move slower. That's just the biggest thing you have to realize. Playing at the money with a lot of time, they're not going to move as fast as you may like, but they're safer for the long-term growth. Golden contract for stocks like DraftKings, American Airlines, NEO, I'm trying to think of just off the top of my head, Ford, Carnival, Mara, Riot, all those kind of stocks. Playing at the money is going to be the safest alternative. They can all move, but imagine if the move goes against you and you're playing 2 to 3 slots out the money. That $10 contract, that $40 contract, it can easily go 60% down, 80% down. Because if we're looking at, say, DraftKings on the week of, look at the delta compared to the actual price of these contracts. This is obviously like we have 1 day left for expiration, so it's going to be extremely higher than what you may expect. If any of these contracts goes against you, so say you get a call for DraftKings tomorrow and it drops on the downside for the week of, the delta for the 2150 call is 0.45. The price of the contract is basically 0.2 at the mid. So if the price of the stock moves down 30 cents a share, 40 cents a share, your contract is practically diminished. It's basically a zero. That's one thing people don't consider. That they're not focused on what's the delta compared to the price action. If we go a week out for DraftKings, it's not going to be as bad if the move happens against you. The 2150, the delta is 0.5. The price of the contract's about 0.6. Obviously, it's still going to be high because then if it moves $1 in your favor, you're practically up 100% for a week out, which is pretty good. But $1 move on DraftKings, that's a 5% growth on the stock shares. That's a huge move. Is that a possible logical move? That's where you tracking stocks over a week, over a month, over a year, you learn how they move. You learn how the contract premiums move based off buying and selling pressure, based off the chart formations with consolidation. If DraftKings consolidates for a week out expiration, your contract is only going to lose like 5 to 10%. Look at the theta for the week out for DraftKings. The theta for the 22 call, the delta is 38. The price of the contract is 40. The theta is 4. So if DraftKings just stays at, let's say, 2150 all day tomorrow, the 22 call for next week, at the end of the day, it will probably go from a 0.4 entry down to like 0.36, 0.35. That's it. You're losing 10%. When you look at other contracts, you have to look at that. If the stock doesn't move, how much will my contract drop in value, even though it hasn't gone up or down? A lot of people don't care about that. And if they're a scalper, they don't have to care. They're not holding it that long. But if you're swing trading a stock, you have to know how it moves. You have to know like what's a reasonable contract based off the Greeks as well. It's all about the correlation and figuring out what's best, not only for the setup, but you as a trader, your account size, your emotions. Can you afford the risk? Can you afford to get that reward that may not be as much as the week of? If you play the week of, your risk is going to be higher. Your reward is also going to be higher. So finding that golden contract, it's more than just, I'm going to go to Netflix for me finishing off this statement. It's more than just looking at a contract for the week of and saying, let's look at puts for the rejection here on the 330 rejection on Netflix today. Let's look at the 320 put. So if you're looking at the 320 put, at the time of that reject at the high, I'm going to mark this on the chart just so that you can see the correlation. I have to just hear me talk. So the white and the white are the correlations. So you're looking at the 320 put and you're thinking to yourself, oh, it's only $27, or let's say it's only $35. Around this area, it was roughly $35 a contract. That's cheap. Imagine if Netflix just crashes. That's how a lot of people trade, not realizing if Netflix just stays at this level and consolidates in a heavy bull flag until close, this contract has to basically go in value. Like it has to gain momentum tomorrow just for you to get out break even practically. If it would have held the high of the day, I don't know what it would have finished at, but roughly probably 0.15, 0.1 a contract. Can you really manage that? Like how would you feel knowing you're down over 50% overnight, and for you to even get in the money if you want to hold it that long, Netflix has to drop $10 in one day. Me knowing Netflix like I do, that's possible. It's not hard to get a $10 move in one day for Netflix, but it's the idea of, is the weakness for a put strong enough to get that drops on the downside? CJ said sounds like it's not worth swinging over the weekend, especially if the stock is flat at open come Monday. The contract will just absolutely lose value. That is correct. If a stock is very stagnant, even like going into close, you never know what can happen over the weekend or even overnight. I know a contract I swung a few days ago for the put side, we gapped down overnight, and that's what made the value go up so much. But if it gaps up, your put is destroyed. That's why swinging is very risky. You don't want to oversize on swings. And if you do swing, it's best to either size light with a very out of the money contract, which is super, super risky. But if you size light, you're expecting zero, basically, a $0 return. If you're swinging with confidence and you know or you think something's going to happen how you see it, you want to size a swing at the money, because that way, if it does go against you, you're not 15 slots out of the money with the move going against you. You're at the money contract the day you bought it will only be 1 to 2 slots out the money the next day. There's still a chance it can come back because you're right there, basically. So you don't always just want to, oh, I could see Netflix dropping $10 tomorrow. I'm going to grab the 320 put. At close, that's reasonable because at close, it was basically 325 a share. That's not hard to get that $5 move downside. And the contract is now $70 a piece, basically. At the high of the day with the 330, my instinct is, okay, it's Thursday, tomorrow's expiration for the week of, I'm going to grab the 330 call. I mean, the 330 put or the 327.5 put. I want to play right at the money. I don't care about the volume. I know from my perspective and my historical trading analysis on Netflix, if the move doesn't happen and I play out of the money, I'm toast. Even if I buy one contract, I'm toast. So I'll play at the money. And if I do get the move I wanted, which obviously looking at it now, we had almost a $6 drop from the highs, $7 drop from the high. Getting the 330 put, it would have been roughly $200 at the high of the day for Netflix. At the time, it's like $200. I don't want to pay $200. Focus on the bigger picture. You're playing right at the money. If it rejects this $331 a share price, which I had this level here for I don't know how many weeks or months now, once it drops down $1, you're basically in the money. So this $200 contract ran to almost $700 in one day. Instead of sizing, let's say you go to the 320, say you size 10 contracts for $270 total for the position. Obviously, those 10 contracts will be worth $1,200 at the high of the day, but it's the idea of not looking at what happened. It's the idea of, could this happen? Is this a logical position for me to take and size this heavy? I'd rather play it safe and not get a bigger reward, only because if I want that bigger reward, I can size the same amount of contracts, but I'll put more money in. That's the only difference. If I put 10 contracts into this Netflix put for the 330 week of, that $2,000 position would have ran to almost $7,000 with 10 contracts. Obviously, I'm risking more money, but if it sits here and doesn't move, my contract's not going to get destroyed as bad because I'm still right at the money being the 330 put. So my golden contract for the week of, right at the money, price is basically $331. I'm playing the 330 put. I'm basically at the money. If we get a reject here like I know it should, I'm in the money. I'm safe. People can chase the other contracts. I'm sitting here not worried. I'm good. I can swing it into tomorrow. I'm already $5 in the money. I can afford to swing one contract and sell the rest. When you play a week out with Netflix, this is when it comes to play with the idea of, do I want to play the 330 put? $550 a contract. I don't know. I have a week. Netflix could keep dropping. I want to play a few slots out the money. At that point, it's your personal preference. What is your ideal contract for your account size, for your personal mindset? 325 put, 320 put, 315 put, maybe 300 put. This is when your thought process comes into play. I can't tell you what to buy. If your account's only $1,000, this 325 put was $300 at the low, almost $400. That's 40% of your $1,000 account. Maybe you should only play the week of and size light at the money, or just play 2 slots out the money and size one contract. Like, that's where the mindset comes in. It's not just tell us the golden contract. You have to tell me what your account size is. What's your emotional standpoint? Can you swing a play? Are you good at holding through consolidation, even though your play goes red even more? Everything is full circle with what we've been teaching since last month. You have to correlate your emotions, your trading style. Are you emotional when you swing? Can you sleep if you hold a trade overnight? That's the stuff you have to consider to find your golden contract. So I'm going to break this down now for the last few minutes. If you have a small account and you don't like risking money, say you don't want to size over 20% of your account portfolio, you may have to play a few slots out the money for the week of. On a Thursday or Friday, though, expiration is right around the corner. You can play at the money, but the risk is going to be higher because there's less time to play. So when your account is small and you don't want to size heavy, depending on what stock you play, Say you trade DraftKings, you can afford to play right at the money. If you play Tesla, you may not statistically from your percent portfolio amount be able to play Tesla right at the money. So maybe you have to find a different stock to play. SPX for a $1,000 account, you may not be able to play at the money. If even size one contract for your account at the money. Now, vice versa. Say you add time to your positions, a week, 2 weeks. You have to find a stock that fits your account size. There's no such thing as, oh, I don't want to play that because it's too expensive. Find another stock that has the same setup, that has the same correlation with what you're looking for, volume wise, possible percent returns based off your entry. Everything finds a way back to you based off what you need. It's not about, oh, I want to follow this person. Can you afford to follow them being down? Can you afford to follow them being up and they're not selling, but you want to sell? Everything with the perfect contract or that ideal golden contract, it all comes back to you, your account size, what stocks do you enjoy to trade, what's the average contract price that you want to enter per. Everything follows suits that way. So when you're doing this, find a stock that you think represents your account size properly based off contracts. The actual price of the stock will not matter if the contracts correlate with what you need. Obviously, with Amazon and Tesla are only $60 away from each other. Amazon's puts at the money are $41 right now. Tesla puts at the money, $200 right now. You have to look at the deeper side of contracts. You can't just focus on, oh, Amazon's only $103. It can move. I just want to buy in. You're not looking at what matters, in my opinion. When finding that contract, you have to correlate it with your account, what you can afford to size. Maybe you only want to size 10% of your account. You can't play Tesla and say, well, I don't want to size at the money, so I'm going to play the 150 puts for tomorrow. Yes, they're cheap, but the chances of that going anywhere, it's very slim. The move today happened. You can look back and say, man, but Tesla had that basically $10 move from high to the low. Is that really going to happen again? Think logical, not just the hope of I could turn a $7 contract into $70. Even if you play the 155 put, oh, I can turn a $30 contract into $100. You could also turn $30 into $0. So it's all about your personality, not just tell us the golden contract like thesis, tell us what it is. So that's really all that I can say. And if you guys have any questions or statements, or if Kenny, I saw you just pop in, if you want to say something about how you find your golden contract or what you look for. Yeah, any questions you guys have? Kenny's about to talk, I'm pretty sure. So type them in the Zoom chat. I'll let Kenny say a few things.
Hey, what's going on, guys? Just hopped in a little bit late here. I think you guys were talking about options, contracts to select, right, Nick?
Why can I not hear? Are you talking, Kenny? My bad. I don't know. I think my laptop may be messing up.
Yeah, I'm not sure if you guys can hear me. If someone could ping in chat.
Oh, yeah, I hear you now. Yeah, I hear you now. You're good.
All right, cool. What's going on, guys? So, yeah, so one of the things I was going to say was that I hopped in a little bit late here. Sorry to miss a class, but one of the things I was going to say with option selection, right, is you guys want to also look at percentages, right, the percent move. I'm sure Nick probably already talked about this. For anyone who trades off the TOS, I think Webull has it as well. I'm trying to see Nick's chart there.
All right, I'm gonna have to pull it up. I haven't taken all. I know what you're talking about. I said in the beginning how like the IV and the intrinsic value change in correlation I wasn't going to bring up just because we can use that like later for course teaching if that makes sense. But you can briefly talk about it because that's one thing that does have to be brought up.
Yeah, so I'm just going to talk about real quick, like something I watch is the implied volatility move, right? So usually what happens is the option chain for the most part will tell you ahead of the day, right? More or less likely what market makers are looking to plus or minus that that dollar move or that percent move. And one of the things you guys want to do is you want to keep this in mind is the tighter. So most stocks, if you've traded basically like VWAP, right, you're going to see that every stock has a specific standard deviation, which is a little bit more mathematical approach to it, of movement that it fluctuates within a day. Right. That's why sometimes you could see, like, for example, Tesla swings super high, swings super low, and then kind of come back in the middle and close, right? That's just the volatility of that stock for the most part, and it trades in a certain standard deviation per day. One of the things you want to look at is, which Nick probably already talked about, is trading contracts mostly close to the money as you can, right? And it's also in accordance to your account, which I know Nick just talked about because I just hopped in and heard that part. So one of the things you want to do is just kind of like, for example, for today, I could talk about, I took a loss on SPX, but the contract I was taking was one strike away. Obviously, the risk was a little bit more obviously like high because it's a 0 DTE, it's the end of the day kind of move, etc. But at what point I was up in the trade and I just couldn't close the trade. I thought it was going to keep pushing and I got caught and I got baited. However, one of the things that you really want to assess is when you're looking at trades that have a lot more time, right? Sometimes it's easy to get afraid to say, I don't want to spend this extra money because I can get like 10 more contracts if I go like 10 contracts out of the money. But you have to remember that these are all probably like there's a lot of probability per contract associated. So the further you go out, right, the less likely the chance, right? And I always say like, okay, the more you pay, you're paying for security, right? So the more that you pay in a contract, it's not that you have to pay like thousands of dollars per contract, but when you're looking at a specific stock, you want to bundle a list of stocks that are contract wise in your budget. So like I say, if you're trading $1,000 account, trading a $2,000 account, usually 10% of that is about $100 to $200. So how can you size accordingly is finding stocks like that might be a little bit cheaper. A big correlation to this would be just looking at the price of the stock. If it's a triple digit stock, usually the premiums are going to be a little bit heavier. If it is a double digit stock like AMD, Intel, what else? Apple's triple digit, but has some flexible premiums. So let's just stay with AMD and Intel, for example. You'll see that the premiums closer to the money, or like Rivian and Roblox, right? You'll see that the closer to the money premiums, maybe one or two strikes away from at the money, are not necessarily that far out, but they're still affordable where you can start to size accordingly, even if you go out an extra week or 2 weeks, right? And get yourself some more time. The other thing too is like when you're trading, for example, I'll talk about my Netflix swing, right? My Netflix swing got crushed by IV because it was way out of the money. But because I bought a lot of time, it enabled me to actually average down, hold the position, and bounce a lot of my premium back, right? Because I knew, okay, I said to myself, okay, like Netflix technically held, it's holding these key levels, it's been really, really strong, et cetera, et cetera. So you want to look at also the time frame. I think that's one of the things that really gets lost in translation is not just where the stock or the price is going in that current day, but the big picture, right? Zoom out, look at the big picture, and say to yourself, like Nick always trades larger time frames, and that's something key to know is like, hey, where's this roadmap leading to, right? Because that's going to allow you to also choose appropriate contracts, being a little bit closer to the money or giving yourself and spreading yourself slightly thin, not too thin, but maybe like 1 or 2 or 3 contracts out.
So yeah, after what Kenny said, if you guys have any questions for him, and if not, I'm gonna wrap up the class right here. I do want to keep the recording going just in case there's any questions that go along with what we just talked about. Everything he said was literally, you basically summed up the whole hour, so that was perfect. Like that was literally perfect.
Hey man, learn from the best. That's being you, man. You got a lot of knowledge, and I know Nick's covering a lot of stuff. So if you haven't, make sure you're taking notes or jotting this down to rewatch this and take some notes.
Said Kenny knows a lot too. Don't think, I mean, he's the one that knows the like deeper stuff that even a lot of people never even hear about. Yeah, I don't think they're not. I'm gonna stop the recording. Well, just the recording section.